Terrific. We're really glad to be back with you guys. And everyone's been pounding us to do another Instagram Live. So we finally said, this is Maxx Feldman. We work for the Goldfinger group. You're welcome. It's my pleasure to introduce you.
Nobody knows me, so I need an introduction.
Max is going to hit us with all the content today.
Yeah, all the knowledge. If you were with us last time, Elijah did say that I brought everything to the table. I brought entertainment and information.
I just bring a table.
What more do you need? So, yeah, we're back with you today. A lot has been going on in the world. Obviously, there's no surprises there. What's been happening, and we wanted to come back, and we've had a lot of people contact us about their investment portfolio, what's going on with the stock market and the economic issues, and they say, I'm interested in real estate now. I'm thinking, I want to move some of my cash. I want to get it into real estate. So why should I do that? Talk to me about real estate and talk to me, how can I do that? And so that's why we're here today. That's what we want to cover is the whys and the hows of real estate, the benefits of having your capital in real estate, and then what are your options in order to get your capital into these tangible assets.
Right. So I guess in any period of uncertainty, it's more important than ever to make sure you're diversified, right? Mm-hmm. To make sure you don't have all your eggs in one basket. And
exactly.
So someone has a lot of their money in the stock market or mutual funds or bonds, whatever mm-hmm. it is, and then they have some money in real estate. They want to be able to diversify to spread out their risk, especially in a market like today where you have a really high unemployment number, but then for some reason the stock market doesn't mm-hmm. reflect that. So you have a lot of these questions and a lot of the inquiries I think that we're having and people that we're talking to are like, well, how can I diversify? Tell me what the benefits are mm-hmm. of investing in real estate and how to go about it. So one of the things that we like about real estate is that it's a tangible asset. So not only can you drive by, you can touch it, you could experience the real estate in your own backyard, literally, and you can choose where to invest and make sure it's in a geographic territory that you are knowledgeable of and you have an understanding of that area.
You can show it to your friends,
your
dad.
Exactly.
Be proud of you.
Certainly yours.
Certainly mine. And what we were just describing too is it's less volatile, right? If you don't see the daily shifts like you do the stock market, right? When we went into the COVID pandemic, the stock market dropped 30%, then it came back 30%, and then it was down 1,800 a day. It's crazy swings, and it's so emotional. People are trading on their emotions more than what's happening realistically, economically with these companies. But real estate's a little bit different. It's slower, it's more delayed because of the dynamics that it takes for a deal to happen. And so due to that, it reacts more slowly and not quite as drastically as mm-hmm. the stock market changes.
Very interesting point, because when you're saying that, it's making me think that if reactions in the stock market are so instant, right? People's emotional mm-hmm. reactions are so instant, so they get on their phone and they make a trade on Robinhood or E-Trade, whatever it is. But if real estate market shifts take longer, then what does that mean for 3 months from today, mm-hmm. 6 months from today? Just interesting to kind of think about mm-hmm. that question.
Definitely, and it's who knows, maybe the economy gets better, so real estate never sees mm-hmm. the shift that the stock market had. We don't know, and we don't know if if there's going to be future problems down the road of rent collection. So far, rent collections have been pretty solid
for us.
Yeah, in the multifamily
yes.
space overall. So if people never fall behind on their rent collection, we may not see it. Who knows? But we could, because of it being a laggard.
Right. And because there's so much government stimulus money in the market mm-hmm. today, but once that dries up, so you got to kind of think about those things from a short-term versus longer-term
mm-hmm.
approach, and realizing the differences in the different markets. Again, stock market and those other equity markets versus real estate, which is a bit slower mm-hmm. moving. I think we could agree on. So the why to invest in real estate. So again, you can touch it, you can feel it, you can understand it. It's mm-hmm. there, it's tangible, comprehensible, and it is, generally speaking, at least for the real estate that we deal with, Los Angeles apartments, is generally speaking, it's a less volatile asset class because there's a constant demand of people demand, again, constant demand of people that want to move into Los Angeles for the many reasons that we talked about on our last Instagram Live. And if anyone wants to, go back to that previous episode, feel free to reach out. Happily give you the.
I don't blame you if you don't want
Yeah,
to.
trust me. There's plenty more important things to do in life.
Exactly.
Now, Max is going to talk about the fact that a lot of wealthy people have created wealth in real estate, and through different ways. A lot of people, it's their nest egg, but a lot of people also, through investing and leveraging their money, have made a lot of their wealth creation has come from real estate.
Exactly, and what we like to look at is who's done it before us, who's done it well. So if you look historically at families, the wealthier families in United States history, they've always owned real estate. They've always gotten rich owning a business or investing in other ways, but then they created the generational wealth through real estate. So we like to use that as a model of, well, they obviously did something right.
Mm-hmm.
And so we have to find a way to not necessarily copy, but see what they did and implement what they did to our strategy. And that's why I think real estate is at the top of our investment list of vehicles, ways to put our money into a market versus what else is available.
So what you're saying, it sounds like, we haven't rehearsed this, so I have to make sure that I'm understanding what you're saying, but it sounds like it's like, yeah, that's true. It's a whole different issue. We have an appointment this afternoon to talk about that. But my point is that real estate's what do you call it, like a tried and tested, tried and proven.
Tried and true.
Tried and true, right? So basically people have been doing it since the beginning of time. I think the second job in the world was real estate. The first one we're not going to talk about, but the second job in the world was real estate, right? Like probably like an innkeeper. Hey, I have this. I created this tent. Who wants to who wants to stay in the other part of the tent? Whatever. Bottom line is that real estate's been around forever. So what you're saying is that this is not like some sort of new technology. We're not sure how it's going to perform, and because it's tried and proven, we have a good high probability. To assume, to project that it's going to perform in the future as well, so long as we make smart investment decisions. Now, I just want to add one more thing to that, which is that although real estate's been around forever, right, it's important to realize that we still need to make sure to innovate, and we need to make sure to keep up with the demand of 2020, meaning what are tenants looking for, what is the market demand for the real estate product, and not think of the market demand in other times.
Exactly. And some of these benefits of what we see through real estate and things that we promote of why someone should invest in real estate, I think the top two, there is the cliche of the ideal investment, which we'll kind of break down, but the two biggest things that I see and when I talk to people is the income that it generates and then the tax benefits. And so the income comes from your tenants that are paying rent, whether it's multifamily, office, or retail. You have renters that are paying you money to utilize that space every month, whether it's for living or for business. And what that income does is it covers the expenses of owning the property taxes, utilities, trash, whatever else there is associated with the insurance. And then it also covers the loan payment, right? If you take out a loan to buy the property, the tenants are also covering your loan payment. And then there tends to be another, let's say the expenses in the loan make up 80% of the income. Well, there's still 20% left over that goes into your pocket, or if you have investors, your investors' pockets as well. So it's a great benefit to have a monthly distribution of cash. And while that's happening, you're building up your equity in the building. You're building up ownership in the building.
Sounds like a good deal to me.
Sign me up.
Where's the paperwork?
It's right here.
Right, sign me up, baby.
Yeah.
I'm ready to go. It sounds terrific.
Exactly. And then you pair that where you get the tax benefits of depreciation. You write off the building. You write off the interest payments and other losses that you have to offset the income. So if you make $100,000 of income, traditionally you pay taxes on the $100,000.
It's all income.
Exactly. But in real estate, let's say you write off through depreciation and all these other benefits, you write off $50,000, you're really only paying taxes on the other half, the other $50,000. So there's much more money going into your pocket rather than paying in taxes to the government.
I once was asking a CPA about this whole idea that you get to write off the interest, you get a depreciation benefit, And I said, like, what's the story here? Like, you know,
Where's the catch?
like, yeah, like the IRS is totally cool. They let you do 1031 exchanges so you can defer. And what he basically said, the U.S. government, the IRS, is interested. They want to motivate and incentivize people to invest in real estate.
Mm-hmm.
So in order to motivate and incentivize people, you have to give them certain benefits. Okay, because when you invest in real estate in this country, you're making an investment,
mm-hmm.
right? And the more investment that you're making, the better it is for the country on an overall basis. And then you know, once
mm-hmm.
there's benefits for that, so then that increases the pricing because people are like, okay, it's a great investment because you get all these
mm-hmm.
tax benefits, which makes people encouraged to be able to underwrite to higher numbers.
Mm-hmm.
And what that does is increases property tax. So it all kind of, you know, it propels the economy, and that's one of the reasons why the government allows for depreciation
mm-hmm.
write-off, interest write-off. And I think it's important just to realize that for commercial properties, you have a 39-year depreciation cycle, which means that every year you're able to write off 1 over 39, whatever that percentage comes out to.
Don't ask me.
I mean, come on. We don't use calculators here. We just, you know, back of the napkin.
Yeah.
Okay? And in apartments, you get 1 over 27 and a half.
Mm-hmm.
So apartments, you get to actually write it off quicker, and there are even ways to do the write-off even quicker, cost segregation. It's a
Capital improvements.
whole different story, but the bottom line is that apartments actually give a greater write-off in terms of the depreciation cycle, but that's for another time.
Definitely. And why don't you expand? You brought up 1031 exchanges. Why
Yes.
don't you expand on the benefit of how a 1031 exchange works and the
Sure.
tax benefits there?
So 1031 exchange is basically when someone owns a property and they say, I want to sell this property and buy a different property. Now, let's say you bought the property for $1 million, you're selling it for $2 million, you have a gain, the profit, the gain, the capital gain is $1 million of profit. Now, the government says, okay, you're going to take that $2 million, you're going to reinvest it into another property. As long as that other property is $2 million or more, you don't have to pay the tax on the gain today. Once you cash out and you put all the money in your bank account, right, if you're cashing out of the real estate business and you're not doing an exchange, then yes, we're going to charge you a capital gain tax. But if you're going to buy another property, then we're going to defer the tax.
Mm-hmm.
And what that allows you to do is to build up a real estate portfolio at a much quicker pace. Because
mm-hmm.
if every time you had to pay tax on your gain, that would reduce your proceeds, reduce the amount of money that you'd be able to put down on the next property. So it is a big incentive, it's a big push to get people to reinvest their money and not to cash out of the real estate business.
Exactly, it's huge, and
huge.
And then there's other aspects too of the benefits, like equity we mentioned. There's, you know, historically real estate always appreciates, especially here in LA, which, you know, when it comes to commercial real estate, it's typically tied to the income, and so we see, you know, rents go up,
mm-hmm.
you know, income goes up with these properties, so that's why they also appreciate, not, you know, besides just natural appreciation. And then there's leverage, and the great thing about real estate is you can easily go get a loan. I mean, I don't know how easily, depends on your net worth. You're probably better at getting a loan than me.
Yeah, it's for a different day.
That's for later. That's for
not Instagram
3 p.m.
Live.
Yeah. And so with that leverage, you can buy a $1 million property with only $300,000 down, or $400,000 down.
Right.
And the way that we look at it is, does the income cover the loan? So you can
Right.
be making money from the bank's money,
mm-hmm.
and then be making money on your money. So it's a really great concept to break down the barrier to entry to buy bigger properties and increase your income, because you can make money on the bank's money, not just your
mm-hmm.
money.
Mm-hmm. Absolutely. We refer to that as leverage.
Mm-hmm.
So you leverage the bank, you leverage the lender in order to make more money on your cash investment
mm-hmm.
out of pocket. So it's very clear that there are a lot of benefits to real estate. Did we cover all of them, or are we missing any?
I'm sure we're missing a ton, but I think we kind of hit the main key points of why would somebody invest in real estate, and why do we like
real estate? Yeah, we hit those points. And I guess what that leads us to is the question of, well, great, sounds like real estate is terrific. Now, how do I invest? I mean, I have, you know, X amount of money. I have, you know, $100,000 or so. You know, I could buy a property on my own. I could invest it into a REIT. I can invest it into a group investment.
Mhm.
I can, so why don't you tell us kind of the general categories of real estate investment vehicles, and then we can dive deeper into each one of those.
Perfect. So I think the first one that a lot of people have heard a lot about are REITs. They're investment trusts set up by other companies. They can be non-traded, so you have large companies that will take $100 grand or $1 million from multiple investors and have a trust set up, and this is more illiquid. Your money's tied up. A company like Blackstone does this, and then you get the income benefits of owning the real estate, and they're typically institutional quality. And what does that mean? It's like owning a $100 million shopping center or a $500 million apartment complex, or multiple complexes. They could be multiple properties that make up this trust and buy the properties.
You said it's illiquid or it's liquid?
Illiquid.
So you can't take the money out?
Correct. But if you buy a stock market one, then
publicly traded, then you could swap in and out.
Exactly. And then that's, and on the publicly traded ones, you're seeing the price fluctuations regularly versus when it's privately owned, kind of what we talked about before, it's not fluctuating as quickly. You don't really know. You're getting your income, but you're not quite sure how your equity is changing on a day-to-day basis.
Right.
So those are REITs. There's a lot of people that invest in first trust deeds. These are companies that issue capital. They issue loans out to people that can't go to a traditional bank. And they, based on the setup, they tend to be a little bit more expensive. So the investor ends up making, anywhere from 8 to 12% on their money. The person who's taking the loan pays, a very high interest rate, 8 to 12%, and then it gets split up. But it tends to be a little bit safer. A lot of people like this. It's easy. There's not as much dynamic as owning property, but you don't get the tax benefits.
Right.
So if I'm making 8-9%, I don't get to write off maybe half of that. So you're paying taxes on the full income.
Right. And a lot of times those are also highly leveraged deals. So you got to be really comfortable with the asset that the loan is placed on.
Exactly.
Right. And there's obviously the original, the OG real estate investment, which is buying the house next door, right? So buying a piece of property, whether first time buyer through an FHA loan, or going and buying a fourplex with 25% down, or buying a commercial property. Usually it's a little bit larger, 35% down payments. But buying real estate on your own, you go out, you talk to brokers, you source deals. You negotiate the contract, meaning you make an offer, the seller counters you, so you deal with kind of those negotiations. Then you deal with the financing to acquire the property in terms of dealing with which bank to go to. Once you close on the purchase, you take over the management of the asset, or you hire a management company. And that is definitely the original way of buying real estate. For people that have time to do it, it's still a great method.
And energy. You have to have the energy. It's a lot of upkeep. It's day to day. It's so if you're running your own business, do you have the time to do it? Maybe, maybe not. Do you have the energy once you come home from the office to now deal with all your real estate projects?
Right. And the appetite, meaning do you have the time, do you have the energy? Sure, but would you rather play, Warcraft? What's it called? I don't even know what's the
I was going to say golf.
Minecraft, NBA Live, Like there's a lot of other things to do with your time, and real estate can be time consuming. So the question is you may have the time, you may have the energy, you may have the resources to do it on your own. The question is, do you want to spend the time? And a lot of the reasons that people sell the real estate, a lot of the people that we buy from, the sellers that we buy our properties from, a lot of times those people, the reason that they're selling is because they don't want to deal with it anymore. So the time factor, the appetite, the energy are all things to take into consideration if you're thinking of doing a deal on your own.
Absolutely.
What else?
You, me? Are you going to take
You know what? I'm a gentleman. You can go first. It's okay.
So the next step is if you do want to do deals on your own, but maybe you don't have the capital, you can syndicate deals.
Yes.
You can raise capital from friends and family, family of friends, friends of family, whatever you want to do. People down the street.
Absolutely. Neighbors.
And do the same thing as if you are buying it on your own. But then this next step that we're talking about of if you don't have the time, energy, appetite, is investing with an operator, somebody that is going out and sourcing the deals, negotiating the contracts, getting these assets under management and dealing with everything, you know, property management, asset management, whatever is involved in those aspects. And, you know, there's a lot of benefits to that, you know, similar to what we discussed, but there are, you know, many other benefits as well of, you know, maybe they're sourcing better deals because they have more time to do it. Maybe they're negotiating prices down because that's their skill set. That's what they know to do. Like, they know how to navigate, you know, where's the money best placed versus, okay, that seems like a good deal, I'll buy it.
Right. I remember we were talking to one of our vendors that we work with, and we asked him, we said, do you invest in real estate? Do you do it on your own? Do you invest with you know, sponsors, operators? And he said, look, I have a full-time job, right? I'm here working 10 hours a day. I don't have the guts to tell you that I have the capacity to focus on investing like a professional company does. Meaning, if you're a professional company that focuses on sourcing deals, that means that all day long you're looking at the market, you're talking to brokers, you're talking to owners, you're sourcing, you're actively, aggressively looking for deals. Right? He's like, I don't have time for that, right? So if I'm going to get a deal, theoretically it could be as good, but practically speaking, it's probably not going to be as good as the deals that, you know, we're picking up. And if I'm not getting as good of a deal, then my return, you know, even after everything, may not be even as good as giving over the funds to an experienced operator who's picking up a better deal, not just a better deal, but in terms of repositioning, operating, managing, asset management, etc., knows what they're doing with the asset. They have a much better probability of getting a strong return on that investment.
And even if you have to pay that operator whatever fees it is, a fee structure to do all this, you're still, you know, there's a high likelihood that you're probably going to come out ahead. And on top of that, you get the tax benefits.
Right.
And that's why, you know, you can still get the income, you can still get the tax benefits without the hassle of sourcing the deals and operating the deals on your own.
Absolutely. Absolutely. And I think we live in a world of efficiency where people are like, look, this is what I do. You know, this is what I do for a living. I want to, you know, work, do my job, spend time with my hobbies, my family, do the things I enjoy doing, and then my investments, unless you're a professional investor, you can give over that money to a professional investor. However, there's everyone's different. So everyone's financial situation is different, everyone's personal situation is different, and there are a lot of people that say, hey, you know what, I want to do this on my own, which is great. You know, if I guess what we can establish is that there's a time and place for everything, and there's certain people that are, you know, that want to invest with groups, and there's certain people that want to invest on their own. So if someone wanted to invest with a group, what would be the things that we would advise for someone to look into about the company, the sponsor, the operator that they're investing with?
It's an amazing question, and
thank you. I read it right off of the paper.
I wrote it up.
You're the best, you know.
I am your assistant, so.
No.
Yeah, and it is a great question, and we get it a lot too from investors that are looking at what we're doing is, you know, why should I invest with you? I know this guy does it, I know this guy does it, and what we say is you have to find what's going to work best for you. And
absolutely,
there's certain points of, you know, what we tell somebody, okay, well, you know, is this person trustworthy? Do they come off like they're honest, they're transparent, they have your best interest in mind? You know, sometimes people look at it, well, cool, I can raise money from investors and I'm going to do amazing. And they don't have the investors, you know, interest. They don't care as much for the investor. They're more in it for themselves. And so I think that's the biggest point is, like, do you trust this person? Do you want to work with this person?
Absolutely.
It's a huge barrier, and it is just so important because you're giving that person money that you've worked so hard to earn and build up and invest properly.
Right.
So definitely trustworthy. And then, you know, once you establish that, then we got to look at the track record. You know, what have they done previously? What kind of returns? And it's not a matter of just the upside, not what they're constantly making, but what's been their worst deal. Have they lost money? How much money have they lost? Or, you know, how are they underwriting deals? What type of risk is there in the deals that they're buying? Which I know you're huge on, and what we focus on at the Goldfinger Group is, yes, upside potential, but what's our worst case scenario?
Right. Risk minimization.
Yeah. Exactly.
Right? So we want to minimize the amount of risk that we are exposing ourselves to and our investors to. And I think one thing that you touched on was aligning interests, right? So making sure that the operator, the investor, the company that you're investing with has skin in the game, meaning that they are also invested with a significant amount of money into the deal, and that they are incentivized, that the structure with the sponsor incentivizes the sponsor to perform the property to the fullest potential, meaning to make the most amount of money for the investors, meaning the sponsor, the operator's compensation is based on a fee structure that aligns the investor, meaning the more money that the investor makes, the more money that the company makes. Okay, so if there is not an alignment of interest there, you really have to look into, you have to ask more questions, right?
Of course.
Okay, so that's important. So we talked about trustworthiness, track record, alignment of interest, and I think one of the things we want to take a look at is the markets that they're investing in.
Yeah, do you like where they're investing? A lot of our investors, and by no means are we trying to like sell the Goldfinger Group right now, but it's a good, we know the Goldfinger Group.
I mean, this is a marketing video. I mean,
It's a good case study, right? We have investors, people have asked us all the time, do you look to go out of state? Would you look to buy an asset in Texas, in Florida, in the Midwest? And what we say is our investors like owning real estate in LA. Now that could change. We could find investors that say, hey, I want to go to Missouri, I want to go to Iowa, I want to go to some other state. But right now our investor appetite is Los Angeles. So, we tell them don't invest with an operator that's buying properties in a city or a state that you don't want to be in. Right.
Meaning if you as an investor have a vision that office buildings in Houston are like, that is it. I want to invest in office buildings in Houston because I believe in the oil and gas industry, and for whatever reason, like that's your thing that you really believe in, then great. Find a sponsor who invests and specializes and is hyper-focused on office buildings in Houston, okay? If you want to invest in, industrial properties in the Southeast, great. Find a sponsor who like that. That's their specialty. Make sure that you are investing your dollars not just with people that you're comfortable with, not just with people who have a strong track record, but also make sure that you're investing with people who are specializing in the investment focused target territory and the product type that you believe in and that you want to put your money into.
I couldn't agree more. And that leads us into the next point too, is like, what is their investment strategy? Is it cash flow? Is it, hey, I'm going to make 8-9% a year? Or am I going to be building my equity in these properties? Am I going to invest $100,000, fix up the property, stabilize it, renovate it, whatever it is, and now my $100,000 becomes $120,000. I made 20%. Now I don't see that money unless we liquidate the LLC, which we talked about. But if we go exchange, my net worth is growing, and there's probably a little bit of cash flow built off of that, but it's not just I'm making 8-9% on my money. I'm actually building up my net worth and my equity.
Yeah, I think on a high level, you have the investment strategy, right? So it means like the overarching strategy of the company is to make money for the investors in real estate. How? Well, we have a focus on cash flow or income properties. You have other companies that, like there's Thomas James Home, and there's a lot of different KB Homes, like all these companies that what they do is they build single family homes and they sell them off. So that's not a cash flow business, meaning that's a buy and sell, buy land, build it, sell it. Okay, we're not in that business at this point in time. If we see an opportunity there, then we can talk about it then. But for now, we focus on income generating properties because we feel that there's lower downside risk associated with those investments. That being said, you have to look at the overarching strategy and then look at the business plan. The business plan is specific to the property, and every property, every investment should have a primary targeted business plan and then fallback options and base cases in case that the target objective has not been entirely achieved.
Exactly. Do you have anything else to add? Why?
I mean, I've been talking so much. What can I possibly add? I want to thank all 2.5 of the people who joined us today. It's really, we're honored, and we realized that maybe a month or two ago when we did the last one, there was more people at home, and maybe now people are at work. But wherever you're tuning in from to see Maxx Feldman, we appreciate it. And we hope to give you more information, add more value to you. If there's anything you want to hear about in terms of real estate or hair products, reach out to Maxx Feldman. And we, again, appreciate you tuning in and hope to do another one of these within the next 16 years as well.
Yeah, exactly.
Okay.
And I definitely just want to add too is if you want to dive deeper in any of these aspects, we're happy to jump on a phone call, coffee meeting hopefully soon as things reopen and people get comfortable. But we're happy to dive deeper into any of these areas and anything that we cover moving forward. Because what matters most is getting the information across to them so that you're able to make the best decision possible for whether you want to invest in real estate or not, but having an understanding of how these things work.
Yeah, and it's interesting because like you're talking to an audience, right? So like who's on here? It can be family, it could be friends, it could be brokers that we know, it could be some of our investors on this, watching this type of thing. And everyone comes with a different knowledge base.
Mm-hmm.
And it's like for certain people, you talk about cap rates and they're like, okay, I get what you're talking about. Let's talk about IRRs. Like, let's get down and dirty, right? So, and then you have other people like, what the hell's a cap rate? So it's like,
I won't put you on the spot.
No, please don't.
You're going to answer.
Do you have a napkin anywhere? Yeah, no, so my point is that there's like you have a broad audience with all three people here.
Mm-hmm.
And for us, it's like, we want to let you know that if there are topics that we're talking about that are a little bit, that you don't understand, right? For whatever reason, you don't digest it, like reach out to Maxx.
Well, I have you talk at a third grade level, so that
Yeah.
makes I understand it.
Yeah.
So maybe it's you do a better job.
Absolutely. It was a pleasure, it was an honor, and catch you next time, guys.
Thank you.